If I could welcome to the stage, we have Mark Burridge, who is Managing Partner at Baker Steel Capital Managers. We have Bert Koth, Managing Director at Denham Capital. We have Alan Corbani, who is a Portfolio Manager at Finance SA. And Peter Weidman, who is Director at the Sentient Group. And Andor Lips, who is from Commodity Discovery Fund, Portfolio Manager there. And he is standing in ably for Willem Middelkoop, who is flown off somewhere. He's gone off. He's gone to go and be more successful around the world on his journeys. Anyway, but so thank you very much for Andor for stepping in at the last moment. So we've had an interesting couple of days, and this final panel, we want to sort of be thinking about where we're going next in the next stage of the cycle. We think the market seems to be in an upswing at the moment, and I'd like to get the panelists' thoughts on what they would like to see companies doing to deliver the best return on investment to their shareholders. What can they do to get the best value for their shareholders? So let's start off, shall we, with Mark. What would you like to see, if you're talking to a management team of a company you're investing in, how would you like to see them play the next stage in the cycle? What are the key things?
Yeah, hi there. Well, working on the assumption that the next stage of the cycle will be more positive than the last stage of the cycle, I think it's quite important that the capital discipline that we've seen returning to the industry remains. But I think it goes beyond that, because everybody says they've got capital discipline and they're focused on costs. And I think what we like to hear from management is that they're really using some smart thinking to ensure that. One of the things that we see, for example, is that unrealistically low discount rates are still being used to value projects and to run whittle, open pit optimizations and things like that. And the problem is we're not investing in mining companies to make 5 to 10% returns. We're investing in mining companies to make big multiple returns. And there's a disjoint between the business planning of mining companies and our return expectations. And I think that gap needs to close. And I think investors need to recognize that there's a balance between growth and returning value to investors. So I think these are some things we like to see. We like management who do foresee more than just theoretically being able to pay dividends to their investors, and management who really think critically about their hurdle criteria for investing in new projects. And I think if they do that with using realistic commodity price expectations and FX expectations, then they should be able to deliver some good returns.
And as they're looking to to grow their companies, would you like to see them do that through acquisitions or through exploration to increase their resource base?
Yeah, I think I think both have their place. M&A typically destroys value in this sector, so it has to be smart M&A, and you don't often see that. I think they just need to apply the same. Management need to apply the same return criteria to M&A as they do to project investment. It has to have a hurdle rate. It really needs to be incremental, not just on an investment banker spreadsheet, but in a strategic and investments have strategic value. Typically, destroy value. We think active exploration programs are critical. The two things that make or break a mining company are geology and people. So you need to have and you've got to focus on working your own assets to reach those inflection points or those debottlenecking points to maximize your returns there before you go out spending money on M&A. It's tough for companies. Most companies think that they need to reach a certain size criteria to be relevant to the market, and then once they reach there, they all get told, well, actually, it's still not big enough, and then they have to. And this is what destroyed so much value in the last cycle. And I think there's a natural point, and perhaps that natural point of growth is where you get to a point where there's no more than 5 layers of management between the CEO and the shift boss. That's the sort of criteria we use. If there's too many layers there, we think it's too top heavy. there's too few, it's also a sign of micromanagement. So you've got to, sort of 4 to 6 is probably the good range there. So these are some of the things that we like to look at. Size-wise, if you're so big that an exploration discovery doesn't move the needle in your valuation, you're too big. But if the success or failure of one project will make or break a company, then you're probably too small. So that gives, rather than putting numbers on the size, that gives some of the criteria that we ask ourselves when we look at a company to invest.
I mean, typically, if you were to put numbers on that, though, what sort of market cap do you think is the sort of optimum?
Yeah, I think if I translate it to market cap, so I think we're looking at 500 million to 2.5 billion. I think that's a market cap range where good management, with smart M&A and intelligent exploration program can really add value to a company. Once you get beyond that, it's tough to add value beyond the strategic M&A type sphere. So, but that size is too small for many investors. So it becomes a real problem for companies.
Alan, what's your take on this? What would you like companies to do, or maybe companies to avoid as we go forward?
This is really. I think this is the most important question of the whole panel discussion. It's about. I'm not too much worried about cost control and cost discipline, because at the stage where we're at now in the cycle, the memory is still very, very live about the fact that we have a mandate, and our mandate is to make sure that we control our costs, whether they are exploration costs or production costs. But the real source of the real pain comes from this lack of discipline in issuing those flow-through, you name them, charity flow-through shares, warrants, half warrants. And when we ask the question to those mining companies, why are you issuing so much paper? Because this paper is literally, in the best case, reducing the return on your investment, and in the worst case, killing literally your return on investment. And the answer that we get is, well, because we don't have any other choice, because nobody wants to finance us if we don't issue those half warrants or warrants. And the reality is that they need to understand that there are other good companies that are really more disciplined in that field, which do extremely well. So the message I have to give to those mining companies is to work harder, go after the investor and convince the investor that, spend more time and convince that, you know what, we have a good project and we don't need to give you additional incentives to come and invest in our story, because at the end of the day, the reality is that this is going to, again, in the best case, reduce significantly the return on investment. And we've seen it so often. It's history repeats itself. Yes, we can reduce our costs, we can look at the balance sheet, we can fix those liabilities, but we don't think about applying a better discipline on the capital structure. And as long as these mining companies don't get this message, they will be penalized. And all you have to do is look at the charts of all these mining companies, especially in days like these. 2017 has been a difficult year, and it has been an even more difficult year for those companies with lack of capital discipline. So work harder, and don't jump to the conclusion that you cannot raise money if you don't issue additional paper that is going to penalize you.
But if you're in a situation where you're running out of money and you've got bills to pay and mortgages to pay and your salary to pay and things like that, what should you do you have the luxury of being able to wait and
well, you see, I had this discussion earlier today with an executive of a mining company, and I asked him, what is better, to bring the wolf into your house, or to just work harder and spend a few more months by raising just enough money to keep going? So no, I refuse. I mean, the good candidates have this discipline. Why the crowd doesn't have this discipline?
But what's your take on this? How do you advise companies to generate the best?
Well, I mean, for us, really, I mean, obviously, my answer is kind of influenced by how we go about investing. But for us, really, the key is that companies bring themselves into production and to cash flow as fast as possible. And I fully endorse a growth strategy, but only by risking exploration dollars out of cash flow. So, for example, what we in the current market would never support financially is what we call binary risk capital into exploration, right? In a pure exploration play. For us, the key is to establish an operating cash flow base first in those companies where we're investing, because once you have cash flow, you're more or less independent of fundraising, you're always M&A exit liquid, you're valued at full value or close to full value, so it is all good things. So I think this is really the market to bring yourself into production, especially while the contractor rates are still low, et cetera, et cetera. So if you wait for a real up market before developing, then you again have input cost inflation and capex overruns, et cetera, et cetera. So right now is actually the right market actually to get yourself into production. Once you're in production, they're positively cash flowing, then you can take a small portion of the annual operating cash flow and actually pursue exploration projects to organically grow. At least those companies that we are invested in, they all follow that trajectory.
But doesn't that depend on the commodity? Because obviously some people might be waiting for the commodity price to rise before they want to get into production.
You know what, the lead time that it takes for a project to bring itself into production, when you wait until the commodity price rises, you might as well miss the boat. I mean, take a look at the zinc market at the moment, right? It's probably going to peak mid of next year, the zinc price. If only now you start to raise the capital for zinc project, by the time you're in production, you'll have missed the peak of the market. So when the market is really down, that's the time when you actually should build a project, because that's when the capex is low, that's when you get the tier 8, tier 1 teams of the contractors, that's when the mobilization period is really, really fast. So when you need a drill rig or something, you got the guys out in 2 weeks on site and not just 6 months later, et cetera, et cetera. So down market is the time actually to develop projects into production, such you have your cash flow base established when the prices go high.
But can you get the funding to get into production when the markets are down? I mean,
well,
obviously
you're asking the wrong guy, because I'm the money, so we have the funding.
Your companies, you can just go to Denham and say, give me the money.
That's precisely it. So,
they go to the bank and the banker says, no, you're a uranium project or something, I'm not lending you any money.
So we have the money, and the companies that we support, all that they do right now is to bring themselves into production, and quite successfully so.
But haven't some companies sort of come a cropper by trying to rush into production and getting themselves loaded up with debt, when and then struggled post getting into production? You see their share price fall off.
Great point. This is why we support our companies with equity, all equity, to get themselves into production, all equity basis. Internally, we say you should only ever be a capital seeker out of choice, never out of necessity. So we want to be in a position where we can tell debt capital providers to get lost if necessary, if the debt does not come to the table at the terms and within the timing required. So this is why we underwrite our projects on an equity-only basis.
And this is obviously why private equity has really come to the fore in the down market.
Sure, because it removes the funding uncertainty of those companies that get supported with capital.
Peter, what's your take on this discussion?
It's a bit twofold. I mean, on the one hand side, we have invested in a let's say, smaller number of very promising exploration companies that were able to demonstrate throughout the cycle that they are able to attract outside capital, and they have fared reasonably well, and we have been reasonably supportive, or quite supportive of these companies. But I would say the majority of the companies we've been working with, they have struggled to survive the downturn. They knew that they had a very reliable partner, and so having a source of capital, they really focused on internal management and taking cost out, which is maybe the right thing to do in order not to go bust. However, what we experience now as the market is turning, we hold sometimes 50 to 90% ownership of one of the listed companies. They struggle to get external financing now because Sentient is by far the largest shareholder. Nobody wants to get on the back seat and enjoy the ride with us. Don't know why, but we have to really not restructure is maybe the wrong word, but work with the management teams in a different capacity, that they try to understand that there is a market which is not sentient and they have to be attractive to the market. And so some of the more managerial and strategic decisions they have to do now is to really think about what is the next step that is important. And we told them, look, we are happy to fund you through that time as well, but we really need to sit down and develop a plan, and it's different by commodity, different by jurisdiction, so it's really on a case-by-case basis how you can position the company that it's able to continue the journey on a self-sustaining basis. And that is one of the, let's say, heavy lifting parts we are undergoing right now.
Fantastic. And Andor, what are you advising companies you're investing in to do?
Yeah, Leo,
as the market picks up?
Yeah, overall, well, the Commodity Discovery Fund is investing in relatively early stage in the cycle, so more on the exploration side, so less on the production side, so less cash flow already around to benefit from. But maybe my comment is a bit in line with what Mark and Alain said before, and although there are, I would say, plenty of good examples around in the market with companies, there's still a lot to learn amongst companies, and it may be very well into that discipline, that focus, and a certain level of transparency, because there are several companies who should also ask themselves, why are they still surprising their shareholders, or why, even worse, why are they still frustrating their shareholders? So there is already something wrong on the communication side, and it may be a very trivial thing, but it is, and it may not be, let's say, an over-demanding shareholder, and maybe some of the shareholders are over-demanding, but that level of communication is still not always right. And companies should ask themselves, where is the issue? And maybe they see with their peers that apparently happen to deliver better on their promises or on their communication. But and I think these issues are rooted in, as Mark and Alain said, so that discipline, whether that is on the financial side or on the technical side, and delivering on your promises, that's obviously something which is in some ways a no-brainer for the companies, but it is still going wrong from time to time. And that's what I would say where companies could still perform better.
And what are the sort of communication mistakes you're seeing?
Yeah, well, you still, and I think this is also the way that the industry is developing, and again, to the good. There are more and more good examples of this. Companies should come out of maybe a certain isolation, should not work, let's say, in an enclave modus and just think that they know better than anybody else on how to progress their project, how to deliver on their project, or how to deliver to their shareholders. There are far more engaged stakeholders and shareholders that could also contribute to the success of that company, and that's maybe where you may see sometimes these things going wrong in the communication, where promises are made that cannot be held, so hence the discipline and the focus, where companies all of a sudden go another way, maybe for very good reason, but then they should explain the rationale of why they make it, and not just say like, well, we know better and the shareholders should just follow us. So there are, that is where very, very basic things, and amongst these hundreds of companies that we're looking at, you still see, I would say, more than a handful where these things happen. Yeah.
Is that a problem you see, that where companies are maybe losing focus? They'll have it. You'd prefer to see them focusing on one project rather than suddenly saying, actually, we're going to be doing this over here as well.
Well, it should all make sense, and it's not a matter of trying to be smarter than your shareholders. And obviously, as a company, you're much closer to the fire, and you're more technical knowledgeable. So you know better in a way. But so you can justify these movements. And so again, if there is a very good rationale or good justification to take a turn and to go into another direction, I'm quite confident that 9 out of 10 of your shareholders, or maybe 10 out of 10, will support you in this, and may even support you more in this, may even bring even more capital if you need to take that turn. But if you have come out on a path and the shareholders have been buying in a certain direction, imagine on one particular project, and then you go somewhere else without, I cannot say without consulting the shareholders, but without justifying on the spot, or preferably more or less before you take that turn, then almost by definition you will frustrate more than a few shareholders.
Unless, of course, that direction you're taking is something particularly exciting, like, for example, I mean, obviously you guys are involved with the Pilbara Gold stories, where some companies have been doing something else and have suddenly found some nuggets on their land. Yeah,
well, of course, and then if there is success, then for shareholders it's very easy to join the party. We can invite ourselves, and but again, clearly there are emotions to this. So if you step on somebody's toes, or if you're frustrating somebody, then you have to work on that relationship again. Yeah.
Alan, you had
Yes, I agree with everything that was said, but you have to make the distinction between shareholders, like Andor he's referring to, and strategic investors. And usually mining companies, obviously, and it's natural, are following the desiderata of those strategic investors. And the strategic investors are greedy, rightfully so. And this is why we have somehow a difference of point of view between the common shareholder and the strategic shareholder. And even though the final objective is the same, which is get a return on your investment, very often it's at the expense of the common shareholders.
Is that why, I mean, Peter mentioned that sometimes he has, people a little reluctant to invest in a project that they have such a large shareholding in? Is there that feeling that, the direction of the company is for the main shareholder, and it's, these people are going to lose out?
Well, if Peter owns, let's say, 20% of a mining company, and I realize that there are 15% of the shares that are issued in the form of warrants or a convertible debt with a 5, 6, 7, 10, 11% interest on it, of course I will shy away.
We've a number of Mark.
I was going to say I don't know if there's a solution. Maybe we have the best system there is for funding exploration companies. I mean, exploration is the lifeblood for this industry, but there are some things that don't make sense. For example, exploration isn't taking an old mine or an old resource that didn't work in the last 3 cycles and calling it a new project. I think unless there's some radical thinking on the geology or there's been a technology breakthrough, that's not exploration. So, and I think that gets lumped into the exploration sometimes. And I think there is a genuine need for new discoveries. Maybe these things in Pilbara will work out, maybe they won't, but let's hope that something like this will happen in the industry to get people's interest back in exploration. The quality of reserves is dropping off in terms of grade. All the projections from major companies, the World Gold Council show that we're sort of, I'm talking maybe focusing on gold here, but projects are going to become harder to finance. And so exploration is needed, but we need to find a different model for exploration financing, which maybe does involve strategic investors, because strategic investors can follow their money, and maybe all investors in exploration companies have to be strategic and be prepared to, if they believe in the geology and they believe in the management team, you need to be prepared to follow your money through good times and bad times. And I think explorers need to know what their skill set is. Your skill set is identifying a target and making a discovery. So your skill set isn't drilling out a resource and developing a feasibility study and building a mine. So maybe there's a point at which a different set of investors and a different set of players have to take over from exploration companies once a discovery's been made. And explorers need to be supported to be able to have multiple chances at making that discovery, rather than having to perhaps promote projects that may not be the best ones, but they're forced to do it and raise all this dilutive capital when it could be better better applied somewhere else. So I'm posing a question rather than offering a solution. But certainly when we back an explorer, which is only 1% of our portfolio, we always know we have to be prepared to back them for a whole cycle to make that discovery, and we also have to be disciplined when we know it's a bust and to move on.
So who should take this role, do you think? I mean, you've said there's needs for more money to come into exploration. You only.
I think there's 2 or 3 different models. I think there's strategic, like you guys, you back a lot of explorers. I think there's a role there to back them. I think there's a role for the intermediate and senior players, as they have done, taking these strategic stakes in companies, joint ventures. And I think maybe where maybe there's a case to be made for good explorers, who know what they're doing geologically, to get to the discovery point, finance that as smart as they can, and then joint venture it, vend it, project generator model, and then take that success and move on and do the next one, and rotate. And I think there's an argument to be made for the really good explorers in this business to do that, because investors like us would back them if they have a series of successes in doing that. And yes, you won't, and I think that's where the biggest value uplift is. You acquire a license for $10,000 to $100,000. You spend a few $100,000 more doing it, and you could have something that's worth, several $1 million. And that's obviously the chances of doing that are quite low. So we think, stop at the point of discovery and let a strategic and industry investor take the financing risk for the next step and move on and apply your geology skill set to repeating that.
So sort of not understand your own skill set and limit yourself to that, rather than trying to overextend.
Yeah, I think it is.
Why do you think people cling on though, and they say, "Oh, I really want to take this through"?
Well, I think we're all dreamers in this business. Well, maybe not all, but all geologists are dreamers. And you think, "Oh, I've got this discovery. It's going to be the next. It's going to be the next Carlin trend, or it's going to be the next Witwatersrand." And it's like and you just want to see it through, and it's very hard to let go because, as you were saying, you get emotionally attached to the project. So it's difficult, but I think that's why carry on. And then, and I think there's a natural tendency to want to see things through, but maybe that end point is create a value, a value realization event for yourself and your shareholders at the point of discovery, which may be 10, 20, 30 times the original investment, even if it's a small amount of money, and take that credibility and that success and that capital boost to try and do it again somewhere else.
Do you think some of these recent high-profile discoveries, such as the Pilbara gold, are going to attract more money back into the exploration sector as investors start to see these companies, share price tripling, quadrupling, and/or?
Well, it's a good question, difficult to answer, because and Alain already touched on it. So if you're willing to take equity risk in supporting an exploration company, then you should be careful and that you not end up into more of a perverse modus that you're trying to shift some of that equity risk to yet another investor. And indeed, we're all trying to make money, but you should be prepared. In exploration, you should be prepared to lose from time to time. With these high-profile discoveries, it is interesting. It gets the market excited, but it brings emotions to the market, and very quickly, you go into some overpowered, over-emotional situation where the destruction of capital is just around the corner, and so where the disappointment of especially the smaller investors or the retail investors is also around the corner, because they tend to come in relatively late when gradually a part of the market at least is convinced that something is going on, and they're in some way they're not able or capable or not alert enough to take the money off the table when all the others may take it off the table. And that's with the Pilbara, that's a very typical example at the moment. I was skeptical for about a month, and I've been there now 4 times and running basically my own personal exploration. But you see 24 companies basically joining the party while you're heading towards Australian summer and temperatures of 50 degrees Celsius in the area. And well, there's not so much to expect for the next couple of months. So companies who just find a conglomerate and can show 3 nuggets to the market are obviously not the ones that really make the party, and you have to be extremely careful on when you tune into that. Yeah.
Sure. Alan.
Back to this Australian story, we have to look at the the history, and we have to listen carefully to the geologists. And I've been spending a lot of time with geologists on this Australian story. And when you have companies trading at these market caps on no drilling, this is not investment. This is speculation, and it's hard for us to jump into a train at this pace with no valid geological proofs. So always in this industry, always you come down to drilling. And if you don't drill, you increase the chances to be disappointed.
It's quite fun, though, isn't it?
I'm more scared of the consequences of the disappointment on the industry than on the return on investment.
There we go. Let's change track slightly. I mean, a number of the panelists mentioned the need to sort of, keep their costs down, manage costs. It's quite easy to do at the bottom of the market when things are cheap. How are people going to manage this as the market picks up? Obviously in the last upcycle, we saw costs get out of control with truck drivers being paid, $200,000 a year, whatever it was. How are companies going to manage those costs as things return? Bert, do you want to?
Yeah, sure. I mean, first of all, I'm making the obvious statement. Everybody's heard it 200 times before. You got up in the bottom quartile of the cost curve, so you got wriggle room and safety margin. So everybody knows that now. What we do, I mean, a few examples. For example, in our Australian base metals platform, we have kind of basically cost freeze clauses in our contract agreement. So, for example, the projects that we're developing at the moment. So even if the various input rates go up, actually the contracts that we have signed, the various development contracts, at least those are not going to suffer from cost inflation. Not sure if one would get these clauses into the agreements today, but it certainly was possible last year, for example. That's one way of doing it. It definitely boils down to management. We strongly believe that a really good management team is able to operate more cost effectively than maybe the average management team. The culture in an organization is really important when it comes to productivity. In the companies that we support, we want to make sure that everybody feels like an owner of the business, as opposed to just an employee, and that goes down to the lowest level employee, because once you have that mindset, everybody understands if the business is run as effectively and as efficiently as possible, everybody wins at the end. Now, in our investment paradigm, we are a private equity firm. We exit incentivized, so once the project's up and running, we sell them. Everybody who is an important member of the enterprise, or who is a important contributing member of the enterprise, actually gets a slice of those profits. So that means everybody's aligned according to the same principles. So therefore, also the staff that is on shift tries to kind of operate as effectively as possible, so there's no 60-minute cigarette break or anything like that, but maybe only a 2-minute cigarette break.
So get them all focused on margin.
Yeah, get them all focused on margin, get them incentivized, and instill the right productivity culture in the company.
Mm. Mark, what's your thoughts on managing costs?
Yeah, I think I think it comes down to that, is making people take ownership of their business and pushing down responsibility and authority at the operations level for companies rather than try to micromanage it from the top. And the cost culture has to come from the top down, not the bottom up. There's no point in flying into a mine on a private jet, and having a big dinner with lots of champagne and all your employees see it, and then you expect them to penny pinch. But I think that another aspect of managing costs actually is counterintuitive, which means companies need to be properly capitalized so they don't have to penny pinch and be pound foolish, if you see what I mean. And that's really important, because too often companies don't capitalize themselves properly, which means they're having to cut corners, which actually has a detrimental effect on cost optimization. And I think the other thing that companies can do, here we're talking about development companies and operating companies, not exploration companies, is move away from, still quite pervasive in this industry, is you've got to seek economies of scale and you've got to seek NPV maximization. And really, if you focus on IRR maximization and you focus on capital intensity, you naturally seek a lower cost operation than you do on an NPV optimization approach to mining. It's very technical and theoretical, but it's how it works. And what you do is, you, rather than looking for scale, you look for those inflection points where an incremental dollar of capital makes a huge gain in terms of your profitability, which basically means things like debottlenecking and proper fleet management in a pit and things like that. One of the other things that may be coming through over the next period that will help to minimize some of the wage inflation in industries is automation. Huge strides are being made in that, and I think there will be a point in our lifetimes where automation actually will for some mining operations make a big difference to be able to limit the labor cost inflation component of the cost base.
Very interesting. Do we have any questions for our panel here? I'm sure you've got some questions. Have a little think. If you want to stick your hand up, we've got some microphones at the back there. But I'd like to get the panel's thoughts on the outlook for M&A as we go forward. Every time we have a conference, somebody will say, I think next year is going to be the big year of M&A in the sector. They were saying at the bottom of the market, everything's very cheap, and we're going to have all these M&A coming in. It's a great time to buy. But what's your thoughts on it going forward in 2018? Oh, yeah.
Could I just ask, would everybody be prepared to say what percentage they've got allocated to exploration in their portfolios?
I would say that my headline figure is somewhere around 2% in terms of what you classify as a pure exploration play. However, embedded in our portfolio and all the operating companies we have a huge exploration portfolio. Every single one of our producing companies has got a great package of land around existing mines with great geological potential. So in that respect, I would, you could argue that we have, a significant portion of our portfolio is exposed to exploration success, but without taking the risk of a single exploration asset, if you see what I mean.
Alan.
As far as we are concerned, I would say that 20% of the portfolio is dedicated to non-producing assets. So by definition, a non-producing asset is an explorer or a developer.
Bert, any explorers?
Well, out of cash flows here, our producing companies definitely assume exploration risk, but I would not issue a cash call to investors for binary exploration risk. So if there's no cash flow, there's no exploration.
Would you ever consider starting a small exploration fund? Like sort of
no, we've did it before. We ended up making much more money by bringing assets into production than. I mean, look, I always say there's two investors. There's the punters who deal with kind of small money and large institutional pools of capital. For large institutional pools of capital, exploration risk is not the right part of town.
Almost as a charity to the industry, you could help them out. Do the right thing, Bert.
Like every private equity firm, we got a big cost of capital. It's compounding on an annual basis. Charity, private money, for me, that's fine, but not institutional.
There you go. Peter.
So my answer is that it depends on how you look at our portfolio, because a big number of the companies we manage have started out as exploration companies, and because we have been holding on to them for more than a decade, which is not really great for private equity, right, Bert? And we're making some changes as we speak. But that basically led to this portfolio that maybe started out with 90% exploration in a way, and then just eventually ended up in production, at least with a number of the companies. But I would say historically we have been very much exploration focused.
Well, happy to hear that, Peter. Because, well, I think on our side, well, roughly I think over 70% is for exploration. So that's companies that are, let's say, pre-PEA stage of activities. And yeah, so a few tens of percent more if you add the pre-production phase. Yeah.
And it'd be interesting, maybe, you probably don't want to answer this, but in terms of, you know, your success rates, do the more exploration-heavy funds, are they doing better or worse than the people who focus on producers?
Maybe but that also comes to what Bert says. Maybe it determines also where your capital comes from and what your cost of capital is. So let's say we are a relatively small fund and we are a retail fund. So in some way, I manage capital that comes through my 600 participants that are keen in some way to invest in the sector and prefer to invest through us. And yeah, by delivering them 75% share performance last year, obviously that makes them happy. But that's basically, as Bert says, if you have the small size of the fund, where let's say the investment of $500,000 may make a difference when it is successful, then obviously you can do that. But if you have more capital to allocate, then yeah, why should you bother in investing so small chunks of money?
Exactly.
What about investing in mining technologies that enhance or
De-risk.
enhance the ability to, like drones or whatever, radars and things like that for detection or mining exploration, or just being much more efficient in sort of discovery process?
I mean, I would say in general terms, it would require a different skill set. Having said that, we have developed a new lithium extraction technology over the last, maybe 5 or 6 years. And I can tell you it takes a very long time. And if we can avoid it, we would rather avoid it than go through that. But all looks good now, so that is nice to have. But I don't think we really want to build a business on that in our case.
The thing is, private equity funds typically run on a cost of capital between 8 and 10% per year that's compounding. So that means time is money, literally. So every year where a private equity firm does not send a significant amount of money back to its investors, that money becomes between 8 and 10% more expensive on a compounding basis, right? So that's how this industry works. We don't like it either as fund managers, but that's how it works, right? And so when you then go into venture capital type of risks like technologies, et cetera, so I would argue that private equity firms at least are the wrong source of capital for that. There are lots of other like the venture capital firms, maybe family offices, but what is generally referred to as institutionalized private equity, like a fund like us, would be the wrong source of funding for such ventures.
Yeah, I think when it comes to funding some technology changes for the industry, whether it be exploration or mining, I mean, I think, you know, we do like to see companies that are looking to adopt technologies, but where they really are going to make a cost-effective difference, you know, and I think, yes, that's the main thing. And I think, for example, drone geophysics has a real opportunity to cut down the time and cost of ground geophysics. So there's a great example, and that's a good way that exploration companies can, with that limited, can actually raise less money, so it can be less dilutive to explore the same target, and it's a great win-win. Having said that, we wouldn't back the drone company, but we would, you know, if it was a choice between two companies and one was adopting the drone geophysics technology, for example, and one wasn't, we'd go for that one. And we apply that to maybe the mining side as well. We don't, you know, we look for companies that are exploring adopting new technology, whether it be remote mining and things like that. But we're not ready yet to invest in a company that's predicting a cash cost reduction because of the technology, if you see what I mean.
Alan, any thoughts?
Yes. On another topic, I wanted to tell you that 2016 was a great year for all of us. We did extremely well, and it was easy to pick the winners. 2017 is much difficult, and because the candidates, the quality, and the valuations are harder and harder to find. So the M&A, back to your question, the M&A will definitely be triggered, but valuations are now at levels that make it difficult for us to pick the right candidates, because nothing is cheap today. Very few companies are cheap and of great quality. This anomaly is hard to find.
Do you think there's also a fear among some of the CEOs of some of the bigger companies? Because obviously, sort of at the top of the last cycle, a lot of the CEOs lost their jobs because of ill-fated M&A transactions. Is there still a lingering fear, do you think, that they might lose their jobs as well if they get it wrong?
We are investing in a cyclical industry, and gold is cyclical. Gold mines are cyclical, and margins will go up because gold will go up and costs will go up. So this is a natural phenomena, and history repeats itself. So I don't think that it's going to be any different over the next 5 to 6 years.
So I would argue, because we've just sold a company a few weeks ago in Canada. So what we see is really, the M&A market is there, right? But it's actually prudently executed, the transactions, as far as we can see.
Yes, because we are early in the cycle. That's logical.
Absolutely. We seem to be running out of time. We can do lots of topics we could still be talking about. We've got a fantastic expertise here on the panel. Anyone have a last question before we?
Just as a response to your question, it seems to me that the exploration money is probably the best part of the cycle right now, because I agree with you. Most of the companies out there are relatively fully priced, unless the commodities squeeze up another 10 or 15%. So I would have thought, and I think Eric Sprott spoke in Melbourne a couple of weeks ago, and they're actually deploying a very reasonable amount of money exploration-wise, and I think that's probably better than chasing the existing producers, and there's not many new quality ones of any scale anyway.
You have still a few companies producing with poor management, and this is where the opportunity could lie for the M&A.
Okay, but as far as we can see, it's probably a good opportunity at the moment for the smaller end of town, the junior end of the market, which is good for most of the people in this room, I think. So I think that's probably a good place to end it. We got some drinks outside, but can I have a big round of applause for our panelists?